Good morning, everyone. For as long as markets have existed, one fact has remained remarkably consistent. The vast majority of retail traders lose money. But what if this predictable pattern wasn't just a statistic, but a structured, exploitable opportunity? That is the core idea behind the strategy we're presenting today, a rigorous quantitative model for sentiment-based contrarian alpha. It's a simple fact. Globally and in India, the vast majority of retail traders lose money. A report from SEBI confirms that nearly 89% of traders lost money in fiscal year 2022. Research from eToro shows a similar trend, with 80% losing money within a single year. Even Nitin Kamath of Zerodha has stated that only 1% of traders consistently earn returns better than a fixed deposit. Fundamentally, the trading crowd loses money due to behavioral biases, and this creates a structured opportunity for us. The greatest weakness of retail traders is that they operate emotionally in the market. For example, when they see a small profit, they book it immediately. But when faced with a loss, they hold the position with the hope that the price might recover. The end result is that winning trades are cut short, while losing trades are allowed to run. This behavioral bias is not limited to a single market or country. It is a global and timeless phenomenon. And where the retail crowd consistently fails, a unique opportunity is created for us. Our solution is simple yet powerful. We systematically trade against retail flows. Our strategy is simple. Wherever retail traders place a trade, we take the opposite position in a disciplined manner. When they incur a loss, our trade results in a profit. In short, we transform their bias into our structural edge. Essentially, if a retail trader buys at 100 and the price drops to 98, their trade is at a loss, while our inverse trade is in profit by 2%. With discipline, we let our winners run and cut our losers quickly. This inversion approach creates a repeatable edge. Instead of guessing the market's direction, we exploit crowd psychology to consistently generate risk-adjusted returns. Therefore, the very behavior that destroys wealth for retail traders is what compounds wealth for Maxx Edge Research. We don't simply follow a random crowd. We first hire traders for a 3-month trial, after which our proprietary scoring system evaluates them on 65 parameters, including overtrading, poor risk-reward ratios, and consistency issues. Only 10–20% of traders qualify through this process. This rigorous filtering ensures we only mirror the most reliable, bias-driven trading flows. In short, our system is designed to select the most consistent underperformers. In our Batch 21 trials, we tested 125 traders. While the overall win rate appeared similar across the group, the 30 traders we selected showed a completely different quality. Their risk-to-reward ratio and efficiency doubled, yet their final P&L was heavily negative. The key insight is that win rate is not the signal, asymmetry is. The traders who consistently generate larger losses are the most valuable input for our model. Our model is an end-to-end automated ecosystem. We provide traders with professional tools, news access, and analytics. To foster a competitive spirit, we've implemented incentive and bonus modules. When a trader takes a virtual position, our software instantly executes a reverse trade in our real accounts without manual delay. Furthermore, we have strict risk controls, including position limits, concentration caps, and loss limits, ensuring risk is always under control. The proof of our model is in the performance data. The retail trader groups had an average monthly return of 7.7%, with very high volatility. In contrast, the Maxx Edge Research inverse strategy delivered an average return of +7.6% with much lower volatility. Our best month was +125.7%, while our worst was only 9.8%. This demonstrates how we convert the crowd's inconsistent losses into stable alpha. The cumulative data is perfectly clear. Retail trader groups consistently destroy capital, with losses across batches ranging from 198% to 314%. The Maxx Edge Research inverse model, on the other hand, delivers an average of +7.6% monthly, with 67% of months being positive. Most importantly, as we scale to over 300 traders, random volatility cancels out, leaving only the consistent behavioral bias. That is the true power of scale. The key takeaway is simple. A behavior that is loss-making at a group level becomes profit-making when systematically inverted. The performance of Maxx Edge Research is more stable and has superior risk-adjusted returns compared to the retail crowd. This is proof that behavioral biases can be a repeatable and sustainable source of returns if you have the right system. Over the last 36 months, the Maxx Edge Research strategy has delivered 25 profitable months and only 11 losing months, resulting in a win-to-loss ratio of 2.27x. Total profits reached 318% against total losses of only 41%, giving us a powerful profit-to-loss ratio of 7.6x. The average winning month was 112.6%, while the average losing month was just 3.7%. This discipline allows us to tame volatility and build smooth, compounding returns. Data from the retail groups shows they were profitable in only 37% of months, with a negative risk-to-reward ratio of 3.75. This means for every 1% they earned, they lost 3.75%. The Maxx Edge Research Contrarian strategy is the exact opposite. We have 2 profitable months for every 1 loss month, and our average profit is over 3 times our average loss. Instead of bleeding capital, we create smooth, compounding growth. Retail traders are generally biased to the long side, with nearly 80% of their trades being buy orders. Consequently, our strategy was predominantly short-biased. Despite the Nifty rallying plus 34% from September 2022 to August 2025, the Maxx Edge Research strategy delivered a plus 275% cumulative return. This proves our model does not depend on the market cycle. It purely harvests behavioral inefficiencies. The Maxx Edge Research Contrarian model outperforms the Nifty from every angle. Our CAGR is higher, and our mean monthly return is 7.6% versus the Nifty's 0.9%. Our Sharpe ratio is 2.46 compared to the Nifty's 0.27, indicating a much higher return per unit of risk. With a correlation to the Nifty of negative 0.08, our returns do not move with the index. Adding our strategy to a portfolio can reduce volatility and improve the overall Sharpe ratio. While our returns are attractive, our risk management is equally important. We have set a strict 10% monthly drawdown cap. If this is breached, all positions are automatically closed. We also maintain 15% of capital in reserve, which is 3 times our historical maximum drawdown. Position and concentration caps prevent overexposure to any single stock, and every trader operates with equal allocation and position limits. Our risk is always under airtight control. Our returns are not a one-off phenomenon. They are driven by secular market tailwinds and the durability of human behavior. Human biases like greed and fear are consistent and deeply ingrained. These twin pillars ensure that market inefficiencies are long-term and repeatable, making our alpha structural and scalable, not a fleeting opportunity. Our model is simple to scale. Instead of increasing trade sizes, we hire new batches of traders. This keeps individual efficiency intact and allows the fund to grow linearly. The NSE futures market, with over Rs 40,000 crore in daily liquidity, can comfortably absorb our flows. And because retail biases are universal, our framework can be replicated globally. We can grow without losing efficiency. Scalability is in our DNA. The Maxx Edge Research model is fully SEBI-compliant. Our traders are contractual employees who trade with virtual funds, and we use their trades as data inputs for our contrarian executions in our own proprietary accounts. Since traders never handle investor money, there is no regulatory conflict. Their salary is performance-based, with 0 downside risk, and this model allows aspiring traders to earn and learn in a safe environment. Our framework is transparent, compliant, and scalable. Maxx Edge Research offers a market-neutral contrarian strategy that generates consistent alpha from the predictable biases of retail traders. Our track record is proven, with over 7.6% average monthly returns and controlled volatility. Our institutional-grade risk framework ensures capital protection. This provides investors with a differentiated, uncorrelated return stream, a true source of alternative alpha. Maxx Edge Research was founded by Mayur Patel, a seasoned quant with over 18 years of experience in financial markets. He began his career in 2006 as an independent trader before establishing Maxx Edge Research. Mayur Patel specializes in designing and deploying advanced quantitative trading strategies, actively supporting proprietary desks and offshore funds with robust algorithmic solutions. His expertise spans strategy development, rigorous testing, and optimization, always with a strong focus on sophisticated models that are capable of analyzing large-scale market data more effectively than traditional human analysis. It is this profound understanding of market mechanics and behavioral finance that drives our contrarian approach. At Maxx Edge Research, we are committed to disciplined, research-driven, long-term value creation. If you are seeking a differentiated, uncorrelated return stream that can enhance your portfolio's overall Sharpe ratio and operates with airtight risk management, we invite you to explore a partnership with us. Please feel free to reach out via phone, email, or visit our Maxx Edge Research office. Thank you for your time and attention today. We look forward to the opportunity to discuss how our unique approach can contribute to your investment objectives.